The Reserve Bank has kept the cash rate at 4.35%. But borrowers are not necessarily out of the woods. Governor Michelle Bullock says another rate rise this year is still quite possible if inflation stays too high. So today I want to explain why the RBA held, why falling inflation does not mean falling prices, and what this actually means for your household. Why did the RBA hold? Inflation has started moving in the right direction. Annual headline inflation eased to 3.8% in June. Underlying trimmed mean inflation was 3.6%. But both remain above the RBA's 2 to 3% target range. The RBA has already increased the cash rate 3 times this year, so yesterday's decision gives those earlier increases more time to work through the economy. The bank is now forecasting headline inflation to ease to around 3.6% by the end of 2026 and around 2.6% by the end of 2027. So yesterday's hold is not the RBA saying, "We fixed inflation." It's closer to, "We've applied the brakes. Now we want to see whether we've applied enough." And if inflation proves more persistent than expected, another increase remains on the table. Inflation is falling. Prices aren't necessarily falling. This is probably the most important thing to understand from yesterday's decision. Suppose something costs $100. If the price rises by 4%, it becomes $104. Then inflation falls by 3%. That does not mean that prices go back towards $100. If it increases another 3%, it becomes a little over $107. Inflation slowed, the prices still increased. That is why you can hear that inflation is improving and still walk through the supermarket thinking, improving? Where? Both things can be true. Inflation can be slowing while your cost of living remains significantly higher than it was a few years ago. Your household experiences the price level, not just the latest inflation percentage. So the more useful question is often, what does your income buy now? Why does the RBA use interest rates to fight inflation? In very simple terms, the RBA is trying to influence how much money is being spent across the economy. Higher interest rates makes borrowing more expensive. Mortgage repayments can rise. Businesses may be more cautious about borrowing. Saving can become more attractive, and households carrying debt often have less spare cash available to spend. When enough spending slows, demand starts cooling. Businesses then have less ability to keep increasing prices at the same pace. But interest rates cannot fix every cause of inflation. Changing the rate does not create more oil. It does not fix food shortages. It does not repair a disrupted supply chain. And it does not work instantly. Rate changes take time to flow through household and business decisions. That is one reason the RBA has chosen to wait rather than immediately rise rates again. What does the decision mean if you have a mortgage? For most variable rate borrowers, yesterday's decision means no immediate RBA-driven change to repayments. But I would not interpret that as nothing to do. Know your actual mortgage rate. The RBA cash rate is 4.35%. That is not necessarily the rate that your bank is charging you. And if you have not reviewed your mortgage in some time, compare your rate with what your lender is currently offering and what is available elsewhere. You do not need to refinance every 5 minutes. Just make sure that inertia isn't costing you money. And importantly, don't build your household budget around assuming that the next move will be down. Another rate increase is still possible. What about savers? Yesterday's hold does not guarantee your savings rate stays exactly where it is either. Banks set their own deposit rates. So if you're holding an emergency fund or other cash, know what you're actually earning. The purpose of emergency savings is not to chase the highest possible investment return. It needs to remain accessible. But accessible doesn't mean you should ignore the rate completely. And what if you don't have a mortgage? Interest rate decisions still matter. And the cash rate influences borrowing and saving decisions across households and businesses, which feeds through to spending, employment, investments, and inflation. But I would be careful about assuming yesterday's hold directly determines what happens to your rent next month. Housing costs are affected by many other things as well. The broader point is that monetary policy affects the economy well beyond homeowners with variable mortgages. So what should households actually do? I would keep it to 3 things. First, know your actual rate. If you borrow, know what you're paying. If you save, know what you're earning. Second, know what your life actually costs today. Third, protect your margin. Do not wait for the RBA to rescue your household budget. If rates eventually fall, great. But your financial resilience comes from having some room between what comes in and what your life requires from you. That margin gives you somewhere to move when circumstances change. If practical Australian financial literacy like this is useful to you, subscribe. That is what we're building here. The RBA held rates at 4.35% yesterday. Inflation is easing, but it is still above the target, and another increase remains possible. So, yesterday's decision is not a victory lap. It is a pause while the Reserve Bank waits to see whether the rate increases already delivered are doing enough. For households, the important distinction remains. Slower inflation does not mean lower prices, and an unchanged cash rate does not automatically mean your financial position has improved. Know what you're paying, know what your life costs now, and protect the gap between what comes in and what goes out. Because ultimately the question that matters most is not simply what is the RBA doing, it's what can your income actually buy and how much room does that leave you? YouTube recommends you might enjoy this video next.